In this video, I will walk you through an end-to-end example on FRTB standardized approach for equity delta risk capital charge. So let's go through this. One table would be instrument where banks will capture all the instruments. So picture this is the trading book. Okay. In the trading book, we have a table called as instruments. Instrument ID is name of the instrument, position, number of units, and lots of reference data columns. What do I mean by reference data is there would be data like time to maturity, other things, contractual data, instrument data, who is the counterparty, and all these things. There could be multiple tables also. This is just a stylized data model. Okay. So we have instruments. Then we'll have risk factors, lots and lots of risk factors. Risk factors could be either equity spot prices. That is what we are concerned with for equity capital charge. There would be volatility surface risk factors for Vega risk charge calculation. There would be interest rate curves, lots and lots of spot curves, forward curves, and when we say curves, it is not one single risk factor. It's an assembly of risk factors. In an entire curve, every single tenor becomes a separate risk factor. LIBOR 3-month is a risk factor. LIBOR 6-month is a risk factor. OIS 1 month is a risk factor. Okay. So you have like lots and lots of risk factors. And then probably you'll have a sort of a bridge table which maps instruments to risk factors. So these two tables are joined. For every instrument, okay, I did a lot of back and forth, so some things probably would have changed. If this is European call, pretend this is European and all of this. Or maybe I can wait, let me update this one here to be consistent. Okay. Map the instruments to risk factors. All right. First instrument is mapped to risk factor ID 1. That means Asian call is mapped to IBM spot price. Second instrument, European call, is mapped to risk factor ID 2, which is Google spot price. Third one is an American call option that is also mapped to risk factor 1, which is again IBM spot price. You'll have something like this. Okay. This is the instrument to risk factor mapping. And then the sensitivities. Okay. Sensitivities could be in a very different table. Doesn't have to be here, but then you have to fetch that data and join the table and add those columns. So what I'm saying is every instrument for every risk factor. So if you're looking at every row, it is a instrument to risk factor pair. Instrument to risk factor pair, correct? With that pair comes the sensitivity. Because you can read it like this. Asian call option has a delta sensitivity of 200 to risk factor 1. All right. American call option has a delta sensitivity of 30 to same risk factor 1. Okay, question. How did I calculate this? This is dummy data. Don't worry about it. Just dummy data. I'm just showing you the structure. I didn't calculate anything. This is what you will have. Okay, I have highlighted 230 here because these are two different instruments but mapped to the same risk factor. Okay, so you might be thinking right now that we probably need to, next step would be to add these two sensitivities. That will give you the net sensitivity against risk factor 1, which is coming from different instruments. I built this page just so that you get a clarity on all the moving parts. Right, this was a toy example, but this will give you a lot more clarity on what actually is going on. So far, so good. Any questions till this point? Clear on this? Okay. So in this table, we map the instrument with the risk factor. The mapping is 1 to many, 1 to n. Because one instrument can map to multiple risk factors. Pretty obvious, right? Instruments are like bundles of risk factors. If you look at an option, how many risk factors are there? Spot price, there is volatility, and other things. If you have a basket option, there could be two stock prices. One basket option will be mapped to two spot prices as the two risk factors. Okay. All right. So that's the 1 to n. And then on this side, you need to do risk factor to bucket mapping. Okay. So my intention was everything that you see in gray would probably already be there in the bank. I mean, if a bank has a trading book, they're managing market risk, all of these mapping would be there already in some form. I put this in yellow because if you're freshly implementing FRTB, these are the set of new calculations that you probably need to do. Okay, because this comes from the paper, not it's not internal to the bank. It may be there, it may not be there, but these are the new things that you need to take care of. So every risk factor, right? We're talking about equity. This is all equity delta risk charge framework. Okay. Risk factor to bucket mapping. That's a 1-to-1 mapping. Every risk factor will be assigned to one bucket, not multiple buckets. All right. And how do you do that? There are three different indicators that we talked about, right? Market cap, economy, sector. And then use these, and there is, so every risk factor, find out what is the market cap, what is the economy that it's operating in, and what's the sector. Accordingly, you'll find the bucket number. For that bucket, I should have put a lookup here, but yeah, so this comes from the regulatory table 1.1. This one. Okay. Once you know these three, you can find the bucket number. So this is a lookup. That's a lookup exercise. Sorry. Yeah. So this part is clear, right? Risk factor to bucket. Now, finally, so these are step 1, step 2, step 3 is we calculate the net sensitivity per risk factor, the total sensitivity. No correlation. Okay. Just net sensitivity. How many risk factors we have? 20 risk factors in this example. So we have 20 risk factors. Against each risk factor, we'll have a net sensitivity SK. For example, in this case, for sensitivity for the risk factor 1, we had 230, that became 230. Simple addition. Okay. Plus minus can offset each other. So against 20 risk factors, we have 20 net sensitivities. Straightforward. Every risk factor is mapped to a bucket, 1:1. All right. Every risk factor is mapped to a bucket. Every bucket has a risk weight. That also comes from the first table. Every bucket has a risk weight. Okay. We got the risk weight. Now you just weight the net sensitivity. WSK is weighted net sensitivity. This is the formula. Risk weight multiplied by net sensitivity, that gives you weighted risk sensitivity. We got WSK. Still, we have 20 risk factors. Okay. How many buckets we have? We have 13 buckets. So next, what we do is, this is the set of buckets 1 to 13. And these are the 20 risk factors. 20 risk factors. Some of the calculation that I'm going to tell you now might seem new to you because those are part of the aggregation logic, but conditional logic that we did not cover fully in the last class. All right. Okay. Now, so these are the this weighted net sensitivity, right? Risk factor 1, which is mapped to bucket 8, has a weighted net sensitivity 115. So for risk factor 1, this 115 entry goes against the bucket 8. Okay. Within bucket 8, risk factor 1 comes with a total weighted net sensitivity of 115. Similarly, let's say, okay, for bucket 8, let's say we have these three entries only. So 115, 25, 12.5. 115, 25. The last one has a 12.5 entry here. All right. So this is the table. And now what do we do? Against each bucket, we have correlations. So these correlations are your within bucket correlations or intra bucket correlations that again comes from the same table, T1 correlations. Okay. And then you can shock the correlations. There are three scenarios actually: baseline, high, low. So based on they have given the formula how to come up with the high and low scenario. This is the formula that I've used. Question from Ritesh: this is the correlation with which risk factor? All risk factors. 15% is the correlation between all risk factors that belong to bucket 1. So this guy, 149 exposure to risk factor 4, 20 exposure that is coming from risk factor 5. Let me see what else. This that's it. These two. So when you want to come up with bucket 1 level capital charge, you will aggregate these two weighted net sensitivities using 15% correlation. Markovich portfolio variance formula. Okay, Markovich portfolio variance formula. Take these, aggregate using 15% correlation, because that aggregation is happening within bucket 1. All right. So that's the baseline, and then we have high-low correlations. The high and low formulas are given. Don't ask me where this came from. That's some kind of calibration, something they would have done, the regulators. Okay. Yeah. So go back to this table again and again until you fully digest the set of calculations. So once we are here, so here I have written aggregate. Yeah. So there's a question. So how many VAR over matrix? There are a lot for each bucket, right? Depending on the total set of risk factor that are mapped to the bucket, you'll have a giant variance covariance matrix. But let's say correlation matrix, because we have captured the variance values here already. But for the correlation, it will be a big matrix, but all the correlations are 15%. So so I didn't do it in Excel. I mean, I didn't use a matrix multiplication in Excel because it will be too big. In Python, you can easily do it, right? So let's say all these 20 risk factors belong to bucket 1. Then you would have a 20 by 20 correlation matrix. 20 by 20 correlation matrix. Diagonal element should be 1. That is always there. Off diagonal elements will all be 15% everywhere, right? Then you will do, if this is W, let's say this vector is W vector, then W transpose correlation matrix times W. If you do that, you'll get the portfolio level, one single number. You'll get one single number, that's the bucket level capital charge. Here I have manually just did it because there are just 2 exposures, such as I just use Markovich portfolio variance formula here. See this? Sorry. 149 square plus 20 square plus 2 times this times 15%. Yeah, you do the same for every single bucket. Then you have capital charge for every single bucket, KB. All right. This is exactly how we calculate the portfolio variance. How do you calculate? There are 2 ways. Either you use Markovich portfolio variance formula that is ugly. This one. This is the formula that I've used. Okay. Or you use a vectorized implementation, vector matrix. That's very neat. Here there is no space to do it, but in Python you can do it. So it will be, so if this is a row vector, right? It will be this row vector times correlation matrix 20 by 20. That correlation matrix will have all diagonal elements 1. Off diagonal elements everywhere will be 15%. So this vector times that correlation matrix times this vector transpose. That will be a single number. That is this number, 153. And you can do it manually. So here what I've done is 149 square plus 20 square plus 2 times 149 times 20 times 15%. Markovich portfolio variance formula. That, and then you take a square root. So basically sigma, because value at risk is linked to sigma, not variance. So we get 153. I hope that it's clear now. Okay, I'll share this Excel. Don't worry. Click on every cell, understand what's going on. But it is absolutely essential that you are crystal clear with all the steps, because this is the core framework. It's the engine. So another question from someone, can you do it for bucket 8? Let's see what bucket 8. Yeah, bucket 8 is 115 square plus 25 square plus 2 into 115 times 25 times 25%. That will give you, oh wait, there are 3 entries, sorry. Let me see. Yeah, 3 entries. So I have done it here. It's basically, you will have this, see. First one square, second one square, third one square, plus 2 times pairwise combination, first and second, plus second and third, plus first and third. Whole into, this correlation is same because it is the intra-bucket correlation. So for all pairwise combinations, it's the same correlation. So it gets expanded. I mean, if there are 3, yes, it is manageable. But if it gets beyond, I would recommend use a vectorized implementation. Don't do it like this. But in Excel here, it's not easy. In Python, it will take a couple of lines of code. But all right. Okay. Awesome. Yeah. So that's baseline. I'm using this set of correlations. And there is a question, is it good assumption to consider same correlation among all risk factors as long as they are within the same bucket? Yes. Within the same bucket, it's like they're all similar. In the same, so look at the bucket definition. We're talking about, let's say, telecommunication and industrials. So the bucket definition is coming from the regulator. They must have done lots and lots of regression, correlations, and grouped them together, and then found out, okay, think of this as a cluster analysis. How many different broad risk factors belong together? Okay, that grouping they have done. And definitely. So on an average, within the particular sector, particular bucket, overall pairwise correlation must be around 15%. That is what they have given. So we don't have access to that data, but that's the idea. Okay. All right. So we are here. Yeah, as I mentioned here, aggregate this using intra-bucket correlations. You will use this formula everywhere except for bucket 11. That is what I think I briefly mentioned last time, but you see this in action here. If it is bucket 11 is special. There is actually no correlation. Why? Because it's the other bucket. Bucket 11 is the other bucket. So we assume everything is kind of like a standalone. The risk factors do not talk to each other. Everything is put into that miscellaneous kind of a bucket. Okay. So the calculation of KB is really easy. All you need to do is take the absolute sum of this entire row. Bucket 11, right? Yeah. Absolute value of this plus absolute value of this plus absolute value of this, that will give you. Yeah, there is only one entry 65, but you can calculate. It's just the sum of absolute values. Okay. This is the aggregation logic. Here. Sum of weighted net sensitivities for bucket 11. All right. Okay. And you do that for all 3 scenarios. Till this point, is everything clear? Any questions? We have only a couple of steps remaining. Oh yeah, there is one more thing. We need this also. This is just a pure sum of, so this is across risk factors, okay? But in the bucket, just a pure sum of all the weighted net sensitivities. This is just a sum. Look at the formula. Sum for all K, that means for all risk factors. Weighted net sensitivity, just a sum. We need that for the next calculation. Okay, I'll pause here. Any questions till this table? All clear. Okay, awesome. So step number 5 is complete. Now it comes down to aggregating across bucket capital charge. So I said, yeah, so here, this is something we skipped last time. In the toy example, it was not very apparent. We have SB, right? SB is the sum of weighted net sensitivities. SB, that means for each bucket, I can just do a pure sum, simple sum of all weighted net sensitivities across all risk factors, okay? But you need to keep in hand the alternative formulation for SB. That will be used if a certain condition is true. So I'll show you. This is the alternative formulation, okay? Look at this. Sum of WSK is the core calculation. That is this one. That is what we did. Sum of WSK. But then you also do this. Max of, min of, sum of WSK, comma, KB, and then minus KB, max of that, okay? I use this formula. But now this KB depends on the correlation scenario. For baseline, you have a different KB here. Baseline, you have a different KB. For high, you have a different KB. For low, you have a different KB because we are using different intra-bucket correlations, right? So for each scenario, KB is different. That's why this alternative definition of SB will be different for different scenarios. So for baseline scenario, if this is the KB, then you put it here. Sum of WSK is already what we have calculated. This is this column here. This column, pure sum. Most of the time, we will use this values of SB only, but there is a condition. I'll show you that. Keep the alternative formulations ready with you, just in case. Okay, you understood how to calculate alternate definition. All you need to do is, this is the core calculation WSK, that is this input. KB, you know, for 3 scenarios, this, and this. Put it here inside. So for 3 scenarios, you have alternative definition of SB. Let me highlight this formula. See, max of min of, this one is already sum of WSK, comma KB. I'm talking about baseline, so using baseline KB in the formula. Minus KB, minus KB. All right. Similarly for high, this is the core component calculation. And then you are using high KB here. So you're getting the SB, alternative SB value for the high correlation scenario. Okay. So keep these ready. All right. Next, on the other side, we'll come back to this. On this other side, they have given the cross bucket correlations or inter bucket correlations. That's called gamma BC. Gamma BC means it's between bucket B and bucket C. Any 2 pairwise buckets. Take any 2 pairwise buckets. We have 13 buckets. When you aggregate across buckets, you need inter bucket correlations. Call that gamma BC. This is the baseline that they have given. All right. And then you have to calculate 2 more for the high correlation scenario, low correlation scenario. For high, this is the transformation of gamma BC. For low, this is the transformation. So I created those 2 matrices for high and low. Every cell is just that transformation, whatever they have given from the baseline. Okay. All right. Now this is done. Now we are ready to calculate the final capital charge. For the final capital charge, we need to use this formula, which is very simple. Sum of KB square. All right. For each scenario, we need to calculate this for high, for low, for baseline. We have KB. Sum of KB square you can calculate across the buckets, right? We're doing across the buckets now. Sum of KB square plus, it'll be a pairwise this thing, 2 times gamma BC times SB times SC. Okay. SB times SC again will come from here. All right, so I'll just give you a simple example. So let's pretend there are only two buckets, only this much. How we will do it? 153 square plus 20 square plus 2 times baseline gamma BC, whatever it is between 1 and 2, that is 15%. So 2 times 15% times SBSC 169 times 70. That's what you'll do. Let me repeat it one more time. If we have only these two buckets, let's say, for baseline scenario, the total delta risk capital charge is 153 square plus 20 square plus 2 times 169 times 17 times 15%. Okay. But if you find that whole calculation is negative, it comes out as negative, then instead of 169 and 17, you will use 153 and 17. Alternative definition. Okay, so if the term within the square root is negative, then use the alternative formulation of SB. So instead of this column, you will use this column under baseline. Similarly, for high, default calculation will use this, but if it is negative, then this will switch to this column. I'll pause here for any questions. So far, so good. I know there's a lot of details, takes time, but you have the Excel, just practice. A few times you'll get it. Okay. And yeah, that's it. So you get the, yeah, so let me finish this process. There's a question. Please repeat last step once. Sure. You look at this default formula. The total K is sum of KB square plus this term. This is basically the 2 gamma BC SBSC. For every possible pairwise combination, B not equal to C. Obviously, B cannot be equal to C because if B equal to C, then we are capturing already here, right? So pretend only there are 2 entries for first bucket, or let me take the another 2 bucket, maybe 3 and 4. Let's say only these 2 are present. Everything else is blank. Okay, so for baseline scenario, or let me take another scenario for, let's say, high scenario. Under high scenario, the using this formula, what will be the value? 116 square plus 22 square plus 2 times 135 times minus 22 times this correlation, 15%, because it is between 3 and 4. All right, that's what this is. But that value that I just told you, if that whole thing, this thing comes as negative, then you cannot calculate square root of negative number, right? If that comes as negative, then you cannot use this default calculation for SB. You switch to the alternative formulation. So we're talking about high scenario, right? So within high, SB alternatively is given by this. So you use this one. Okay. I hope that's clear now. Yeah, go through this Excel, okay? And for this calculation, I have used a shortcut actually. Here I could do matrix multiplication. The only thing is, say this. Let me actually write it down here. We have our final calculation as this. Square root. Okay. This is equal to sum of KB square. What I saw is calculating this in Excel is impossible. If you have like a lot of, you have 13 buckets, right? So this term will be 13C2, 13C2, number of pairs. Difficult, right? How will you do it? So many combinations. But easy way is, if we had this term, pretend, and this, I did this. Okay, I added a sum of SB square, which you don't need to calculate, but I added and I subtracted. This part is simply, this part is the Markovich portfolio variance formula, right? So we can use the matrix multiplication. So SB vector transpose gamma BC variance covariance. This correlation matrix, I already have it in my Excel for all three scenarios: high, low, and baseline. Why I had correlation for the inter bucket and not intra bucket? For the simple reason is I know that for inter bucket the dimension is 13. It'll be a 13 by 13 matrix, which I know. But in when we are doing intra bucket, in the bucket there are 20 risk factors, and for every row you would have to calculate a correlation. So that's why I didn't do it. Okay, here it is 13 by 13. So let me write this as gamma BC. That's a 13 by 13 matrix, right? Depending on the scenario. And SB. This simple matrix multiplication will give me this part. I can calculate this easily. It's there. This also I can calculate because it's just a sum of 13 different numbers. For every bucket, calculate SB, take the square, take the sum, 13 different, adding 13 different numbers. Here also I'm adding 13 different numbers, and this is elegant, right? So this is equal to this. So that's what I did. Otherwise it would have been impossible. So I'll show you. See, sum SQ, summing the SB square. Sum SQ, this is this square plus this square plus this square. Everywhere I'm doing the same. I will use these. How am I using this? Basically, look at this. SB transpose, correlation matrix. Sorry, yeah, this is the correlation matrix. And again, SB transpose, correlation matrix, SB. Add the sum of KB square, subtract the extra sum of SB square that I added, take that out. So ultimately you have the same formula. Did you get it? Did you get it? So sum of KB square, matrix multiplication, minus sum of SB square. That is what I did. You have to press Control Shift Enter so that the array formula would work. Otherwise, it will not work. Okay, so for default, I did that. And then for high scenario, just use the high correlation. And for low, use the low correlation matrix. That's the default. In default, as in, I'm using this set of SB. You can use alternative setup. Anyways, I calculated alternative. If I use alternative, what would be the value? I calculated that, kept it ready. All right. So here I'm just using the this baseline, and here high, and here low. Alternative. Okay. Finally, you check the condition that if your default capital is actually negative. This is yeah. If this is negative, then switch to this. Otherwise, keep this. None of these is negative, right? So we keep the original calculation intact. Finally, your K is square root of that. I didn't take square root anywhere. So finally, I'll take the square root. So that's your capital charge. Delta risk capital charge at the entire portfolio level under these three scenarios. And finally, you take the one that is the worst. So max of all this, 549. This is all. So I have included all possible calculation scenarios and everything. This is the final sort of framework. Try to be absolutely comfortable with all these calculations, especially starting from here. Some net sensitivity, weighted net sensitivity, aggregation, all this. Any questions? So there's a question in options for delta risk charge, time that is theta also comes or only, no. When we are talking about delta, we are strictly talking about change in spot price. Theta and all are not, theta and all are not part of this framework. You don't capitalize theta actually as per the standardized approach because nowhere you see the time effects. However, for backtesting purpose, when you calculate HPL and RTPL, right, the two time series of PNLs, there, if you include theta effect, you have to include it at both places. Otherwise, your backtesting will not look nice, right? You are comparing HPL, which is a hypothetical PNL, and then this theoretical PNL that your trading models use. There, if you want to use theta effect, you will have to use it in both places. The actual PNL, APL, that definitely includes theta effect. All right. But when it comes to regulatory capital charge, you are not using time effect here. The reason is we are, yeah, I mean, for that liquidity horizon, we are already adjusting the main underlier with a huge swing, 20 days, 10 days, or whatever it is. So that there is like a big source of change. The time effect and all will not be that much. Yeah, I mean, if you start to include theta effect here, your capital charge will change a little bit, not much. Theta effect is not that huge. It's the main driver for the change in option price is the underlier stock price. So, and we are talking about a huge change in stock price. Theta will not be relevant that much. But yeah, for backtesting purpose, you have to use it. As per the standardized approach, there is no need. Any other question? Okay, all right. If there is no question, then I hope you found this useful. Let's take a break here because it's a logical stopping point, and then after the break, we'll talk about the curvature risk. All right. Okay, let's see. Let's meet after 5 minutes.